This podcast is brought to you by Nuveen and Ruffer. Nuveen has provided investment excellence for 125 years. With expertise across income and alternatives, Nuveen continues to expand its capabilities while maintaining its legacy as a leading investment manager. Visit nuveen.com to learn more. Investing involves risk, loss of principal is possible. Ruffer is a London-based asset manager founded in 1994, managing over $25 billion for institutions, pension funds, charities, and individuals. They have a single investment approach that aims to deliver positive returns across the full range of market conditions. Investing involves risk, loss of principal is possible. Our next guest has dedicated his consulting career to public pension plans and Taft Hartley plans. Hear about the challenges and headwinds facing this segment in the US today and how consultants are pivoting to rise to the challenge. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Kevin Leonard, who's partner and practice group director, public funds and Taft Hartley at NEPC. He's had a long career in consulting and started his career as an accountant. Welcome, Kevin. Thanks for joining me today.
Great. Thank you. Glad to be here.
Let's start by talking a bit about your background and career journey. Can you tell us where you grew up, what you studied, and how you came to enter the world of investment consulting?
Yeah, absolutely. So I'm the classic Boston story, grandson of Irish immigrants that settled in Boston. My parents raised us right outside of Boston. Went to college in Massachusetts, so didn't really branch too far away. Graduated college in 91, and I'll jokingly say at the time, State Street Bank and Trust, which was, I would say, a small to mid-size firm, was the only one really hiring back in 1991. So I started out as a portfolio accountant at State Street, working within the public fund group, doing accounting as it relates to pension funds and the custodial work. Spent 2 years there, didn't love what I was doing, wanted to really get into the investment business. Was working south of Boston, living north of Boston, and I'll jokingly say I was probably more motivated about just finding a job in Boston than knowing what I really wanted to do to shorten my commute. I always like to say, I think in life, it's a matter of where you are at any point to help you with your fortune. There was a colleague of mine sitting next to me. She received a phone call from one of her good friends who was working for an institutional consulting firm, very small firm in Boston. It was called the Hanna Consulting Group, that was run by John Hanna, who, side story, is a Hall of Fame football player. He played for the New England Patriots. He was a broker in the offseason and had seen an opportunity in Massachusetts to work with the small regional cities and towns, the pension funds in Massachusetts in the mid-'80s. So there were 6 people at the firm. I started with John as more of a performance measurement analyst, quickly began working on investment manager research, asset allocation modeling. And as we grew the firm, a year after I joined, John said, "You're going to start going to client meetings." So I guess Eve and I was probably, at that point, probably not qualified to be an investment consultant, but as you know, back then it was easy. It was 60% US equities, 40% investment grade bonds, and maybe sprinkled a little bit of core real estate. But I was extremely fortunate to just get that opportunity and really start working in the consulting community at a very young age. And I learned really quickly that this would give me an opportunity to really branch my career out. I knew at the time I was meeting really smart people, working with really good clients. And I said to myself, this is my MBA, this is my CFA. If I can kind of pursue myself through this type of career, work really hard and build a brand for myself, I thought I could build a career. And I did that. I worked really, really hard and worked long hours, showed John that I was passionate about what I was doing. What I loved about consulting at that young age and I still love today, which draws me to do what I do, is knowing that I'm helping people, retirees, so police, fire, teachers, DPW workers, really helping them secure their future retirement. And again, meeting really, really good people. So I started at the Hanna Group. I worked there for 6 years. Unfortunately, John needed to sell the firm. From there, I went to work for Siegel Advisors, which is part of the Siegel Company, became a partner at Siegel Advisors, spent 12 years there, again, working mainly with public funds. I did work with some Taft Hartley, Endowment Foundation, healthcare, but really started broadening my skill set, working with larger clients, married 2 young kids at the time, and I was traveling a lot. And I had to make a decision of, Did I want to stay in consulting or did I want to go into more of an asset management route? Did a lot of soul searching and said to myself, I really love consulting. If I'm going to stay in consulting, I really want to work with a firm that can get me access to really large, sophisticated pools of assets. So at the time, I was working with small cities, towns, counties, small Taft Hartley funds. And to me, if I could work with an organization where I could be a consultant to large, multi-billion state pension funds, big city pension funds, that's where I wanted to go. So I joined NEPC, had a lot of success there, became a partner of the firm there, ultimately became the head of the public fund practice, and more recently was promoted into the management group of NEPC, overseeing both public and Taft Hartley. And today I work with some of our largest and most sophisticated public funds. So it's been 32 years now in the consulting business. I jokingly say I'll find a way to make an easier life, but the passion of helping people and really being challenged on a day-to-day basis continues to draw me back to, I guess, what I really do love.
Really interesting. Not the first person who kind of accidentally happened upon the career of investment consulting. It's for some reason, I'm not sure if it's done a better job now. A similar thing happened to me. I didn't know about this role. It just didn't sort of fall out of the business school milk rounds or kind of recruiting drives that we saw. And maybe that's just the kind of people, it's the curious that attracts the curious. You have to seek them out. I want to hear more, but very interesting. So, of course, we met on the public fund circuit. I was CIO of the Chicago Police Pension Fund. You were our long-term trusted and continue to be a consultant there. So love to talk to you about that world now as you see it. Maybe, I don't know if we have the same aspects between public fund and Taft Hartley or take them separately, but where do you see these entities at this juncture? What challenges are they facing? Are they growing? Are they shrinking? What's on their mind?
Yeah, I think, public funds, I would say, definitely have a number of challenges in front of them. I think the first is really what we would call pension envy. I think the funding of pension funds, as you know, Ethan, are partially investments and then also contributions, which ultimately come in from taxpayers. And I think, politically, more and more people are looking at increases in taxes and then realizing that those taxes are going to pay the pensions of people. And I think you and I fully support that. We know that. We understand the mechanisms of that. But I just think in this very political world we live in, there's a lot of kind of negative views over pension funds. And I think that's just because on the private side, pension funds don't exist like they used to. So there's probably some level of pension envy or pension jealousy. And so I think that's a challenge there just from the pure funding mechanism. And, municipal budgets, state budgets are very tight and everyone's fighting for every dollar that they can possibly get. And outside of paying of salaries and medical costs, pension costs tend to be the second or third most expensive line item on these pension budgets. So it's very political from the funding. Many mature public pension funds, and even as you know, in the city of Chicago, that has been a long-term challenge of being significantly underfunded and generating negative cash flow, meaning that there's more money going out of these funds than is coming in. And that has certainly required unique ways to manage portfolios, to pay attention to those. And I think, although it's a natural progression of mature pension funds, you have more retirees and active members, that continues to grow and becomes a challenge for pension funds. I think on the good side, we had lived through a low interest rate environment, which ultimately forced many of these pension funds to take, I would say, excessive risk, underweighting investment grade fixed income, overweighting alternatives, overweighting growth assets. Good or bad, we're in a higher interest rate environment today. That's a positive for these pension funds. They're getting more yield income into their portfolio. They can de-risk some of that overall equity risk that they've built into the portfolio. And I think that's ultimately a positive. The other mechanism, which I think, coming out of that low interest rate environment was the reduction of actuarial assumed rate of return. So, which is a big function of how these public pension funds become funded. When I started in the business, the average assumed rate of return was 8.5%. There were some US public pension funds that had a 9% actuarial hurdle. Those now are down to 6.5%, 6.75%. So if you think it is a lower hurdle to try to outperform. So with interest rates up and the outlook for fixed income much healthier, again, I would say the trend today is looking at de-risking of portfolios. And even I always tell people the one thing that you taught me when we were working together is most US pension funds have this growth mindset. Let's grow the portfolio. And you always said to me, let's focus on income, which is obviously more of the European model. I think that income focus is now the trend of US public pension funds, mainly given the lower assumed rates of return and the higher interest rates. But I think that's a good thing. And again, we're seeing increases in fixed income allocations. We're seeing allocations into things like private debt. And I think more recently, which is a very hot trend or topic in the public fund space, is infrastructure investing. So that income generation, I think, is definitely a trend that you're going to continue to see in the US public pension funds.
We're going to take a short break to hear from one of the sponsors of this series, Ruffer, a London-based asset manager founded in 1994, which manages over 25 billion for institutions, pension funds, charities, and individuals. I sat down with Jasmine Yo, fund manager, to dig a little deeper into culture at the firm. And let's talk about culture. What would you say characterizes culture at Ruffer?
Two main things. I think it's the fact we're a single strategy house and we've got diversity of thought. So firstly, everyone here is working to deliver the same mandate, and that facilitates an open, collegiate environment. People really care about what we're doing and they buy into the strategy and the role that it can play for investors. The other thing is the wide range of backgrounds of the people at Ruffer. The firm is a bit of a melting pot. We've got historians, economists, linguists, statisticians, creatives, and that really supports an important feature of our process, which is to combine quantitative and qualitative analysis. So we're not just sat here using data sets to solve the problem. Quantitative analysis informs us and has been very important, but it is ultimately a limited data set in a historic sense. Now, at Ruffer, we think it's essential to also have an appreciation of history, but too an imagination for the future. And it's that qualitative lens that leads us to our core insights and really allows us to position for the risks ahead of time and take advantage of the subsequent opportunities.
And now, back to the show. Really interesting, and we'll dig a little bit more into asset allocation trends just in a bit. But in terms of size, pooling, obviously we look across the border, we look out to Australia, New Zealand, we see these super funds with some of the scale advantages, the increased bargaining ability, and ultimately maybe the different career structure for the officers because of different resource base. How do you see that evolving? Do you see more pooling? We've seen it in the Illinois Police Fund recently on the horizon.
I do, although I'll overlay that with you're always going to have to deal with the politics. So New York City, for example, has, I believe it's 5 underlying pension funds with 5 pension boards. There is one staff though, right? So it's one staff that oversees the 5 funds, but there's 5 different consultants, there's 5 different investment strategies. Logic might say, well, geez, shouldn't we pool those all together? The unions are very adamant about that because they want to have self-control over their funds. So I think there's definitely arguments on pooling of assets could lead to lower fees. I also think, though, one trend would be, good or bad, would be the influence of consultants in this day and age. And I think, NEPC is an independent consulting firm. We don't receive any fees from managers. So when we're negotiating fees on behalf of our clients, we're negotiating what I would call bulk pricing. So if you think we have 1.3 trillion in assets under advisement. So when we're underwriting an alternative asset management firm, we're getting fee breaks for any client that goes into that fund. And so they're looking at it from our scale and the amount of money that they can have. We've been very successful in the liquid space when you think about index fund providers really lowering fees, saying, let's do bulk pricing. So I think the argument obviously is the consolidation of assets get you lower fees, can get you access to managers. And as you mentioned in Illinois, there was so many small little pension funds that they just couldn't get access to some of the better ideas. When you look at states like Florida is very similar to Illinois with a lot of very small funds. I don't see that consolidating like we saw in Illinois. So I don't know if that's a trend, but certainly the logic behind it is in this day and age of where alternatives are going to be very important to the outcome of a portfolio. Some of these small pension funds that might not be dealing with some of the more larger sophisticated consultants, in my opinion, could be left behind a little bit because they won't have the scale and the access to some of the better managers and better asset classes.
A very interesting trend, especially around the evolving role of consultants, which we'll get to, but let's not leave pensions just yet. So any investment beliefs that are core to you that you then use as a way to influence asset allocation at the public and Taft Hartley plans?
Yeah, I think my philosophy is definitely changed over the years. And I think being in the industry as long as I have, I would say in the probably the first third of my career. Again, it was very simplistic 60-40 type allocations. There wasn't much volatility in the market. It was buy and hold strategy. We didn't see a lot of downturns or big macro risks. And I think probably in the middle part to now where we are today, the reality is public pension fund investing has to be certainly be always long-term in nature, but you have to be willing to be tactical. You have to be willing to look at what's transpiring immediately, the midterm and the long term. So I would say to you, NEPC is very much continues to be a long-term investor, a long-term horizon. We also recognize that there's risks that our clients need to protect against in the short term, and there's opportunities that do arise. And I think, one of the things that we've been working with a number of our clients over is governance structure. Even as you well know, in Illinois, in the city of Chicago, it's a public RFP process. And a lot of the work you did took a long time because we have to issue an RFP and we have to analyze RFPs, and it could take anywhere from 6 to 12 months to implement a strategy. And that time frame in today's age, you could miss an opportunity. And so we're seeing a trend. We work with a couple of clients that have been given the full ability of staff to implement the investment policy within the investment policy ranges and the recommendations of their consultants. And so when you look at what I think would be some of the better performing public funds today into the future will be where staff is given some of that delegated authority to manage the portfolio on a day-to-day basis within the direction of the investment policy of the board. I just think that those funds that aren't willing to do that could be left behind a little bit, given just the sheer volatility we see on a day-to-day basis, and just the 100-year storm that used to come now seems to come every 12 months. So I think delegation of authority to staff. Now, obviously, some of the small to mid-size public pension funds are not going to have the staff to do that. So one of the other trends we are seeing in the public fund world is OCIO, where you delegate some of that authority in the implementation of a portfolio into a consultant. I don't say that thinking that we're going to change the model, but I think that gets back into when you talk about the consolidation. If you're not going to consolidate, do you maybe give some of that authority over to, quote, an external investment expert that can do some implementation on a day-to-day basis?
Really interesting. And I suppose if the delegated model works, what's the role of the board there? And I suppose tied to that, we talk a lot about board competence, board confidence. Clearly, the more that's delegated, the less granular detail that board needs to be educated on. But even if it's selling policy, it still needs to be educated around strategies, around evolving market backdrop, as well as things like maybe responsible investing, climate change in some areas is a hot button item. How do you, I suppose, bridge that gap?
Yeah, I think that, listen, the board of trustees are there to act as fiduciaries. They have a fiduciary responsibility, and ultimately they are responsible for making a determination on what the asset allocation needs to look like, given risk profile, given liquidity requirements. I don't think that should ever be taken away from a board. A board's role is either they meet quarterly or they meet monthly. They're not there day to day. And I go back to the kind of just that implementation. I don't see or want to see boards delegating all authority to anybody. It is their responsibility to be educated. And I think in the relationships we have where there is delegated authority to staff, what we're doing is we're not going into meetings and spending 4 hours on reviewing performance. We're not spending month-to-month meetings doing investment manager searches. The board is able to kind of step back and really just be focusing on asset allocation, what's going on in the macro environment, right? You and I have seen these studies before. Depending on who you believe, anywhere from 85 to 95% of the outcome of an investment portfolio is asset allocation. So one of the things that I've definitely seen in my career is boards and investment committees tend to focus on manager performance, maybe less on asset allocation. So I think when there's some level of the day-to-day implementation handed over to either staff or it's in an OCIO model, it allows the board to focus on what is the most important part of managing a portfolio, which ultimately is setting asset allocation and understanding what's going on in the macro environment.
I wanted to take up one of those points around some of I mentioned some climate change and some of the factors that we need a board to be more competent on. And also you talked about governance models, and many boards are diverse. On the topic of diversity and inclusion, this is now certainly in Illinois an obligation, a mandate, an aspiration that has not only affected the public funds, but also their service providers like investment consultants. So what would you say is the current, I suppose, evolution of that trust?
Yeah, I love this topic because I think where we are today is a massive step forward from where we were even 10 years ago, 20 years ago. When I first got into the industry, when you talk about diversity, it tended to be the cities that were very diverse to begin with, where there was demand for working with diverse managers. So think New York, Chicago, Detroit. It wasn't a broad-based, and I don't mean it was anti-diversity, I just don't think it was of mind, except for in those cities where there ultimately is diversity on the decision makers. So if you have diversity on the decision makers, the board members, then they're going to ask for that and demand that. And I think what we've seen over the last 20 years is just the diversity of the employees of cities, counties, states, which ultimately now sit on the board. And it's bringing diversity of thought, and it's stepping back and saying, let's look at who we're working with from a service provider perspective. At the end of the day, we have to be working with really good managers that are going to meet the investment policy philosophy of what our fund is, but making sure that we're purposely looking for diverse asset managers to come to the table. So I would tell you what used to be very regionalized, and ultimately it ended up being, as you know, index fund providers that may have owned index shops that were diverse owned, and it was the easy way out to just say, let's put our index exposure into a diverse manager. It is very much very broad-based across our client base about diverse programs within their program. It's something that we at NEPC are very passionate about. And I would even tell you that is expanding into our endowment and foundation practice. It's expanding into our corporate practice. So it's not just a public fund story anymore. It really is an institutional story about the demand for more diversity within portfolios. And we think it's great. It's now focusing even more in the alternative space. If you're building out a diverse program or want to work with diverse managers, obviously the purpose is to make sure that we're bringing positive financial outcomes to these asset managers. And so we've definitely seen a big increase in diverse managers within the alternative space, within active management. So it's very much broad-based now, and I would say very much common within the majority of our public funds.
And does NEPC have kind of a golden rule when it comes to some of these sometimes thorny political issues that tend to overlap with investment policy from time to time? Do you have a preferred course to steer there?
So, I mean, at the end of the day, we don't view our job. I mean, we as a firm are very big believers within our organization about having a diverse organization. And so I think that matches the mission and philosophy of many of our clients. I think when you get into some of the ESG components of what we've seen, so I think early in my career, we saw things like Northern Ireland free ammunition, tobacco. I think those are very much political. We at NEPC, we're not active in that role because, again, we have a diverse set of clients. We have, in this day and age, I think even as you know, in the political landscape of this country, there are very much some regions of the country that are big believers in ESG and big proponents, and there are some parts of the country that are anti. And so I would say from the aspect of some of the political things that we've seen, we work with both type of clients. We have the resources. Again, we have a big practice within the endowment foundation world that is very pro ESG, and we have a number of clients that are very much pro ESG. So I think it's more of, from a diversity perspective, it's who we are as a firm and the mission we're trying to accomplish. Some of the ESG political aspects of that, if I can say it that way, are more certainly client specific, and we work with a vast array of clients that approach it differently.
And last question, just on the manager side, a little bit tied to this diversity question, but it really relates to culture. So we speak a lot about what goes into due diligence, but increasingly, I think there's a focus on the culture of the firm, perhaps how that relates to its longevity, succession planning, and just maybe generally the engagement of its employees. How much do you find that you're looking at culture now when you look at different asset managers?
It's a big piece of what we do. So Sarah Samuels, who joined us 6 or 7 years ago, my life's flying by. Sarah was the deputy CIO of Mass Prim. She worked at the Wellesley University Endowment Fund. We asked her to come in and take a look at how we're doing manager research. And I think if she was here today, she would tell you that NEPC did a really good job from a quantitative aspect of evaluating managers, but maybe we weren't from a qualitative aspect looking at it from that lens. And sure, we were doing our due diligence and reference checks and speaking with managers and trying to feel and correlate culture in an organization, but it is very much, I would say, the quantitative aspect of manager research to the qualitative now is probably just as equal. And yes, looking at firms that have that true culture of supporting their employees, supporting diversity of thought, freedom of thought, and being much more of a broad-based kind of team approach than that kind of somebody sitting at the top making all the final decisions, which does exist today in the institutional business. But certainly, I think diversity of thought has led to better outcomes. And so absolutely, it is something that we've spent much more time on and being a bigger piece of ultimately how we underwrite firms and underwrite products. And I'm a father of 2 kids in college, and I would tell you that they know much more about investments than I did when I was in school. And I think the younger generation is much more confident in who they are. I think when you and I got it first into our careers, right, we were told to just show up, shut up, and do your job and don't ask any questions. I think it's a very much different culture. And again, I keep going back to who we are as an organization at NEPC. It's very much a flat organization. Titles don't mean anything. It's really a collaboration and allowing everyone to have a voice. Ultimately, you have to have somebody or a group of individuals that have to make decisions based off of that. But making sure that everyone's involved in a decision, we think is ultimately important for who we are as a firm. And so ultimately that plays out into the asset managers that we're ultimately going to recommend.
And looking out maybe into the crystal ball, 30 years, I think you said, in investment consulting.
Yeah.
Not many that can I say have watched that arc of development of a segment of the industry. I'm not asking you to look out for the next 30 years, but even just the next 5 or 10 years, how do you see the role of the investment consultant evolving? And I do note already the important role you mentioned around the aggregation factor, this fee negotiation, the kind of almost the quasi pooling results without needing to see the pooling. But what will it be? More OCIO, more collaboration? How is it going to look?
Yeah, I think the first thing, I think the role of, as boards, if we believe that just people are getting smarter about investments in general across society, that means those individuals that become board members are going to know more than what board members maybe knew 20 years ago. So I would say in the first half of my career, it was very much the consultant made all the decisions. The boards just pretty much checked the box. Okay, what the consultant's telling me we're going to do. I think that is absolutely changing across all sizes, particularly in where I work in the public fund space. Ultimately, I think it's 2 things. It's at the end of the day, asset allocation advice is very much going to be driven by the consultant and staff. And then the implementation of that with regards to the types of investment managers that boards want to work with. I think our role becomes more bringing ideas to the table and having more of a collaborative decision on who ultimately gets hired between staff, the consultant, and the board, where before it was a consultant just came in and said, hire this manager. Technology is going to become much more important about what board members are looking for. I guess I'll jokingly say, I'm probably still using too much paper and pen. Our clients want more access to data. They want more access to research. They want more access via technology to some of the underlying manager research we're doing. So we've seen a consolidation in the consulting world where some of the smaller mid-sized consultants just can't kind of keep pace with that. So I think you'll continue to see some level of consolidation because of the demand of technology. And I think one of the things that we really hang our hat on is our deep research group, having dedicated people to just pure research across asset allocation and the underlying asset classes. That is costly. When I got into consultant, my role was to be a consultant, a marketer, a client service person, a research person. You were asked to do everything. I'm very fortunate to be at an organization where I still have to know all of that, but I have a lot of deep, smart people working with me that are fully on a day-to-day basis, turning over rocks and leaves, coming up with good ideas. So consulting firms that have deep research, I think, are those that are going to survive, and those that are kind of looking forward from a technology perspective. Another trend we've seen is some of the big asset management firms now, the BlackRocks, getting involved in some aspects of consulting, particularly within asset allocation modeling. I think they're doing it more, coming in, being able to go to clients and saying, hey, here's our ideas, because selfishly they have product behind it. So I do think the consultants will always win out on that as long as you're conflict free and you don't have any underlying purposes for that. But we've definitely seen some of the larger asset managers trying to kind of tiptoe into what some of the traditional consultants do. It will always be asset allocation and it will always be investment manager research. I think the more use on the alternative space. You're definitely seeing more indexing on the traditional side, although we can talk about this on another podcast. I think you're going to start to see more of a trend of active management come back in. But access to alternative managers, alternative manager research, I think has become more heavily weighted on the consultants.
Some really interesting insights there. And I think certainly on the board pack side, all you can do to get those board packs down in terms of volume, I think will always be appreciated. They've got far too big. 300, 400 page board packs, I think, do not always make for good governance. And of course, getting back to that potential for conflict, I suppose some of that is driven by fee sensitivity, right? By the clients are driven to free services or bundled services because of fee sensitivity and resource constraints, many of which these public funds experience. And I suppose then for you, that comes a value for money equation about delivering value for those fees. So not an easy thing to solve for, but certainly interesting to hear the evolution. So I'd love to move to some personal reflections now. Looking back at your career, we talked about these 3 decades here. Would you say there were any setbacks or challenges in there where you learned lessons?
I think I learned lessons every time I walk into a board meeting. It is the one thing that always is a challenge. And I think it's probably why I've lasted as long as I have, because you're meeting new people constantly. Board members are changing, views are changing. It forces you to be your best every meeting you walk into. You can't get too comfortable. I could have a great relationship with a board today, and there could be a political change in leadership. And next thing you know, you have a completely different board you're working with. And so I think that is a level of frustration sometimes, because it takes a long time to build relationships and then those can go away, but it does force you to be your best. I think probably the one thing I've learned over my entire career is to be a better listener. I go back to the beginning part of my career where I would walk into a room and I would talk for 2 hours and not get a question, and they would just do whatever I said. And that was the model. Today, it's very much a collaboration. And so for me, it took me some time to speak less and listen more and understand the dynamics of that. And then I think just the relationship with asset managers, learning a lot. I always say to asset managers that we all have an equal place at the table. Asset managers can bring just as much to a relationship as a consultant can. We have to be looking at this as a kind of a 3-legged stool, right? There's the client and staff, there's the asset managers, and then there's the consultant. There's enough ideas out there for all of us to kind of work on. So I think the collaboration with the asset management communities is something that I've learned over the years. I've been very fortunate to work for great organizations that have given me a lot of freedom and a lot of resources. So, but it's the constant challenge. As I said in my opening, it was 60-40, and now today it changes dramatically, right? We're looking at private equity and private debt and real assets and real estate and infrastructure. And there's just the world has changed and new ideas are constantly coming. So it's constantly learning. I mentor a lot of younger people at NEPC, and I tell them today, I still get nervous every meeting I go into, even though I've been doing it for 30 plus years, because you just never know what's going to come up in a meeting. So there's the fear factor behind that, but it's just a challenge to always be your best, and it forces you to do your homework and be knowledgeable. And, I would tell you, I recently got something that it really made me feel good about who I am in my career. I work with the city of Detroit. They're a long-term client of NEPC. As you're probably well aware, they went through a bankruptcy. So that has been a very challenging pool of assets to manage. But the previous chairman of the investment committee was a senior executive at Ford. He ran Ford Credit. He ran Ford Europe. And he recently stepped down and sent me a nice note and said, Kevin, I thank you for your courage to work with the city of Detroit and bringing the great advice that you brought. And when he used the word courage, I didn't think about it in the way. I always look at it, I'm coming in doing my best. But I guess if you step back and you think about what you're doing on a day-to-day basis and the responsibility that we all have in managing hundreds of thousands and even millions of retirees' future pensions, I guess if you think too much about it, you could probably get too scared. And that was a moment that I guess I allowed myself to step back and think about what I'm doing, and it made me feel really good.
Well, that's wonderful. Is there any last word of wisdom or creed or motto? And we've already had lots of wisdom flowing through this conversation, maybe from one of those consultants that were mentors to you, or managers that you've met with, or some of these inspiring clients who dedicate their lives to public service, or anyone within your circle.
Yeah, I know. I appreciate that. I go back to the beginning of my career when I was a 23-year-old kid that didn't really know much, and John Hanna gave that kid an opportunity. I want to pay that back. And so I think my heart always leans into giving the underdog a chance. So I kind of been a big mentor to a lot of people at all my previous firms, just to tell them the story. How I got into consulting doesn't happen anymore. That doesn't happen. You don't just happen to get a phone call and show up at a small firm when you're 23 years old. And I try to use it as a story, though, to say I built a good career in an industry which is dominated by really smart people that come from Ivy League institutions. And I try to tell people at the end of the day, it doesn't matter where you learn, it's how hard you work, it's how much you care about your clients in this business, it's how much you ultimately care about the benefactors of these funds, and knowing each and every day the purpose of what we're doing. Because as you've seen in this industry, there is a lot of egos. There's a lot of people in this industry that are doing it for the money. And so I think the one nice thing about consulting is what I learned really early in my career from John, and even at NEPC through Dick Charlton, is the passion we have for it. Sure, I say I make more money than I ever thought I possibly would, but it's more about knowing that I'm helping people on a day-to-day basis. I'm in an industry that's very challenging, learning something new. And ultimately, unfortunately, I'm of the age now where I can pass that on to the next generation, but that's also rewarding. So to me, I try to tell everybody, work hard, have a strong ethic, be honest, and treat everybody with the level of respect that you want to be treated. And there's a lot of opportunity in this industry for people that can do that.
Well, thank you so much, Kevin. Having come from a fund that did have some of these scary realities, like you mentioned around Detroit, not quite at that level, I do think your courage was extraordinary in both coming there, being a very safe pair of hands, and giving us confidence to plow the way forward. I think what I've learned through this podcast discussion is how you bring together this deep commitment to service with a very clear sense of humility and authenticity. So thank you so much for coming here and sharing your insights with us.
Thank you. I really enjoyed it.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear from more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.